I have very good feelings about the week ahead. We'll take a deeper look at the jobs report from last week because I learned some stuff today that I wasn't aware of. The question is whether FUD or FOMO will win as we head towards Tesla earnings. The PPI should matter more than the CPI, but will it? And then also, what is happening to bonds right now? What will happen to bonds this week? Anyway, this is Randy Kirk. If you like our Sunday night news report, which we've been doing now for a few months, and people seem to definitely to like this, we talk about what's going to happen in the week ahead in terms of financial and also in terms of Tesla, if there's any news and or expectations with regard to the stock. And I will definitely report down at the bottom what I think is going to happen to Tesla stock this week. Okay. Also, by the way, I'm going to do an essay tomorrow. I think you're going to like this. Hit subscribe and notify if you want to be reminded of this. I'm going to talk about Elon Musk's humility as a huge Tesla moat. What exactly do I mean by that? You don't want to miss that. That'll be tomorrow. If you want to find out what it is ahead of time, you can read the Elon Musk mission. I've talked about this, 8 months ago when that book came out. But I've also got some new ideas about it, and I'll be discussing those tomorrow. Probably midday is when that essay will be out. All right, this coming week, we will not first of all, it's later in the week, but we'll have JP Morgan reporting along with Wells Fargo, Citigroup, and BlackRock, all these major banks. And this starts off the earnings this quarter. Almost, all the big E guys all report this quarter, including Tesla. And so the banks are an important part of what everybody's paying attention to all the time, but certainly in this environment. Because if the banks miss by a lot, or if the banks show any sign of weakness, this will actually be maybe a good signal, the signal that the Fed would have to pay attention that the banks are having trouble because of interest rates being so high and because of money being drained out of the system. And that maybe it's time to forget about this rate increase that's coming up later this month. I don't think that's going to happen. I think the banks are going to do just fine. All the reporting that's been around the banks for the major banks for the last few weeks has been that they're doing just fine. Some of the regional banks, not so much, but that's not what we're going to see this week. We're going to be talking about the big guys. But if there's a big miss, the market will react. But I think the big action is all going to be CPI and PPI, but this could be something that would, if you get so this is JP Morgan's on Thursday, which is the big of the big. If CPI and PPI give us an inclination one way or the other, then JP Morgan could just increase that inclination in one direction, or it could offset it. So anyway, pay attention. The Fed will be watching. Clearly, they'll be watching what's happening to the banks. Now, they should already have a heads up on it. All right. Of course, the Fed will be all over the news this week because of the CPI, the PPI, because of the banks reporting. But no less than 7 times this week, Fed leadership will be out there talking about the economy, talking about what the Fed is doing. What could possibly happen here? We can guess that the various speakers will have agendas that are designed to keep business enthusiasm dampened down. I read the other day, this is kind of a shocker to me. I know that they want more people in unemployment lines. This is clear. They want the unemployment numbers to go up, and they want the employment numbers to go down. They want the pressure on job wage increases to go down. They want people to make less, and they want them to be out of work. That's bad enough. But I understand it's a long-term thing. You have to do it. But they want to dry up people's savings, because people have way too much savings right now. They have way too much in their bank accounts. They have way too much in savings. And they want people to be out of savings so that they'll stop spending, because as long as they got plenty of money in the bank and in the savings account, then they don't mind going out and spending a little more. Well, anyway, that's a rant. Let me go past that. So a little deeper look into last week's employment numbers that seemed to come in a little bit, they were a little bit low to begin with, a little bit lower than expectations. But it turns out that almost all the gains came from government and construction. Major gains from the government, and then a decent gain from construction. Well, and there was a little gain in manufacturing, but nothing to get excited about. So there's other indications out there that there's a slowdown in the overall economy. And maybe there is beginning to be a slowdown in jobs. Unfortunately, I'm not seeing it anywhere else. I need to see a lot more data for me to believe that there's any slowdown in the job market. We'll be reporting a little bit more on that later in this particular edition. Well, there are a bunch of folks out there that are trying to push the recession into next year. So I don't hardly see anybody right now thinking that we're going to have a recession in the next 2 quarters. So now we're pushing it into next year. But that gives us a lot of time. That gives us like 5 more CPIs and PPIs, 5 more PCEs. That's the other, the Fed's favorite inflation guide. Gives us 5 more months, 6 more months of looking at the daily trueflation. Gives us all kinds of time to look at job numbers and wage increases. And, so much could happen in that time. And if it looks like we're going into recession, but if it looks like inflation's under control, I think we could even see the Fed lowering rates before the end of the year in order to keep us from having that recession. So as you know, I'm just continuing to show you proof that I think there's not going to be a recession. I just don't think it's going to happen. And if we do, it'll be extremely minor. One
particular pundit I was listening to said maybe it would be like the 1991 recession, which ruined George Bush's chance of being reelected. It was such a minor recession, but it was just at the wrong time. Anyway, so obviously the biggie is we get the consumer credit number. I'm sorry, not the biggie. So here's the stuff we get next week. It starts out with the consumer credit numbers on Monday. These are expected to contract a bit, and that's a trend. They've been contracting and contracting, so people are backing off on credit cards a little bit. Again, they have money in their checking accounts and they have money in savings, so they're backing off on credit card spending. And there were some alarming trends earlier this year where it seemed like people were really putting a lot of money on credit cards, but I think that has now changed, and it looks like that trend is continuing. Well, we'll see on Monday whether that trend continues. Again, I think the Fed would like that. Wholesale inventories get reported on Monday also. Now, unless there's a massive uptick, I don't expect a market reaction. If there's a massive uptick, well, that could be bad for the economy, because that means that the manufacturers and manufacturers overseas, importers, don't have to buy as much, and that could begin to say, "Hey, we are headed towards a recession." But of course, that would be good for the Fed. This is this backing down, this good news, bad news thing. There's also the possibility there'll be a big drawdown. Maybe the inventories will draw down a lot. That would show that we need to rebuild inventories, which would be good news for the economy, but not good news for the Fed, although it's not necessarily inflationary if they're in line. And right now, there's no indication that that inventories will drop so much that it would be out of line with normal kinds of movement of inventory. Now, the small businesses are saying that their inventories are low, so it wouldn't be surprising to see this number come in a little low, but we'll see. PPI, the purchasing professionals, their expectations are positive right now on the manufacturing side. So I would say a drawdown might be in line with what they're thinking right now. They're a little bit light on inventories and need to buy more. On the NFIB Optimism Index, that's what I was going to talk to you about, what I mentioned earlier. So that's the National Federation of Independent Businesses. I was a member of that for a while. Small business owners get polled, and they ask about their expectations about the future economy. And right now, the street is expecting this to be up from 89 in May to 90 in June, which is a nice increase, but it's way under the normal average of 98. So the owners are still cynical. They're concerned. Their number one and number two concerns, they're still concerned about filling jobs that they have open, they can't find good employees for. And they're also worried about having to pay more for workers. And then because they're paying more for workers and paying more for raw materials, they're having trouble passing along these costs. And so these are the things that small businesses are concerned about right now. That would indicate to me that they're, again, one of my theories I started bringing up last week, you'll probably hear me talk about this a little more. After we've had this wild up and down that we've gone through with inventories and not enough product and too much money chasing not enough product and then too much product, all of this wild swing that we've been through for 3 years, at some point we get back to something like even, But then we could get to normal pressures, okay? Normal pressures like, I'm a business owner, I haven't been able to raise my prices for a while, now I need to raise them. And if there's kind of a general throughout the economy where all these business owners are like, yeah, I got to raise my price, I got to raise my price, well, then that ripples through the economy, and you might see another tick. And the Fed might be worried about that tick, even though it may not be a long-term issue. The other side of that, as I've mentioned over and over again, is we have this chat GPT thing. I've been trying to research this. The whole GPT thing and all the large language models and all the rest of this are, I know, you know, I think we all know it's going to dramatically impact the cost of doing business. It's going to help with labor costs. It's going to probably reduce definitely reduce some of the folks that can be replaced because of it. But I can't get Chat GPT and I can't get the Bing version. I can't get either one of them to give me any information on that. Yesterday, the Bing version actually cut me off and said, I'm sorry, I'm not going to have this conversation anymore. So they must recognize that there's folks out there that are, maybe upset about the potential for layoffs. I mean, I could read it to you. I could put it up on the screen. I was laughing pretty hard when they actually cut me out. But no, they won't give me any stats. They won't even give me a list of the companies that have already reported, like Microsoft, like IBM, have already reported that they're going to reduce job openings, job opportunities because of these GPTs. Okay, moving on. Okay, so then we have Wednesday comes the big gun. Let's see, did I get? Yeah, I caught all that. Okay, Wednesday, there's the big gun. The CPI headline numbers will be, what everybody looks at, because that's why they call it the headline number. But the Fed is way more interested in core. So the headline includes everything, all categories. And then if you don't already know it, the core takes away food and energy because they tend to be volatile. But actually, the big question is not going to be food and energy. The big question is going to be housing. And so this is why I think a lot of people are upset with this entire business of the core, because it's not about the core. The big number in core is housing. And I can assure you, every other report out there, you can go to, the one that brings all these together is the Trueflation report. They're looking at the Chase Shilling. They're looking at, the major guys that do this stuff on a daily basis, that are looking at housing prices and looking at rents like Zillow, like Redfin. And all of these guys are reporting that rents are flat over last year, maybe even trending to down. And they're also reporting that while housing prices year over year are down, they are now inching up, but they're still down year over year. So, and that's certainly my experience, everything I'm looking at. And as I've mentioned to you before, I do know a fair amount about the real estate market. So, okay, what about, yes, the core. So what are we looking for? Okay, what you're looking for is you want the core to be at 3% year over year and or 0.25 month over month. If we hit that number, that's going to be the market is going to be joyous. That's what they're expecting, by the way, is 3% year over year. That's what the expectation is. And they're also expecting that as both on the core and also the headline, interestingly, because a lot of times those will be different, but right now that's what's expected on both. So the market will be very happy with that. If it's a lot higher than that, nuts. So if it's a lot higher than the 3% year over year, then the market will not be happy, and there could be some sell-off, and you can see the bonds going up, because that might mean two more 25 basis point raises. But if the core is less than that, then you can have a lot of joy because maybe it's in time to get the Fed to keep from raising here in a couple of weeks. Anyway, I'm thinking probably it's going to come in pretty close to that number, because I look at Trueflation, and Trueflation is currently at 2.5 year over year. But a month and a half ago, they were around this 3% year over year. So I think this is probably a good solid number. Could be a little higher. If it's 3.1 or something, it's not going to matter. Okay. So we also know on Truflation, it is sliding down. It's been kind of even, up a little, down a little for the last week or so, but otherwise the trend line is so dramatically down on Truflation. Look it up yourself, truflation.com. And I don't make any money from giving you that. It's just advice. So while the market digests the CPI and all the Fed presidents reporting, and there's just absolutely no rest for the weary, because on Thursday comes out PPI. Now, I personally think that the PPI is more important, as it's a leading indicator. What buyers are paying for stuff now is going to be reflected as it rolls through the economy a couple of months out. So I don't know why the Fed doesn't say that this is their most important gauge. But anyway, the last month, the headline was down 0.3%, and it's expected to be up 2%. The year over year is supposed to be up 2%, showing a 2% overall up this month. The core was at 0 last month, and the street doesn't have any current estimate for this month. So I don't know. We'll see what these numbers come in, but I think the market ignores the PPI. They pay most of their attention to CPI. I really don't see the market reacting strongly, except maybe as a confirmation. So if CPI is bad and PPI is bad, that would be confirmation. If it's good and good, you get my point. But I do not see any chance that a bad CPI would be corrected by a good PPI. Didn't happen last month. I don't think it'll happen this month. All right. So also out on Thursday, besides JP Morgan, is initial jobless claims. These are expected to be about the same as last time. I have no clue. My guess would be yes, it's about the same as last time. Nothing else to suggest that there'd be a big change. But and I don't think it, unless it was a complete, like, goes from 220 or 230, whatever it was, goes to 400 or something, but then that might be seen as an anomaly anyway. The pre-market, last time I looked, the bonds are up in the pre-market. Hard to know whether that is signaling worry over bad news on Wednesday, or whether it's just a capitulation to the increase that's coming later this month. About the same as they were, just a little, the 10 years a little over 5. The 2 years not quite bumping again, not quite to, I'm sorry, 10 years bumping just a little over 4, and the 2 year is almost up to 5, and the 2 month is way up there over 5. Okay, oil is down just a tad, but it has been strong up this week, going from maybe a 67 up to a 72, 73, but now backing down under that. That probably is profit taking. I couldn't find any news that would suggest that is something fundamental. The markets in the pre-markets are showing no trend. NASDAQ was down a little, the Dow and S&P were up a little, but then that was changing. So I don't see any trends there. Okay, what about Tesla? As far as I can find, there's no significant news over the weekend that would shake up anything. Now that could change by tomorrow morning. So tomorrow morning the video will come out right about 7:10 California time, 7:15. Look for that. If there's any news overnight, I'll report it then. And so I'm just thinking that the bulls and the bears are going to have at each other all week long and into next week. The bears will be trying to grab their profits if the stock shoots up towards 300, and the bulls will be in FOMO mood, trying to make sure that they buy as much as they can possibly buy before earnings, and because we all know that there's almost always a run up to earnings, and then the day after earnings the stock goes down for a few days. Anyway, I'm thinking that's exactly right. So I have no reason to think it's different. Now, there could be huge news this week, massive news on CPI that would crush it, or CPI that could really make things go crazy. There could be news from Tesla that we're not expecting. Maybe some breakthrough sightings of an actual Highland or something without any wrap on it. Anyway, I think there's a low risk that we're going to see anything but this movement up and down, up and down, and up and down towards 300, maximum 305. I don't see it going above 305 before earnings, but it could, with a bad print on CPI, we could be looking back down to the 265, filling in that gap that the technologists are telling us about. So that is how I see it as of this Sunday night. If you liked this presentation, please hit like. If you like this program in general and you haven't subscribed yet, please hit subscribe. We need more subscribers, lots more. And then, of course, buy the book and join Patreon. And yeah, I think that's it. It's been great talking to you.